Capital Ideas, The Improbable Origins of Modern Wall Street, by Peter L. Bernstein. This is a book summary. Today, we're diving deep into one of the most thrilling transformations in financial history, the revolution that reshaped Wall Street forever. Imagine a world where the stock market was seen as little more than a casino, where prices seemed to dance randomly without reason, and the idea of predicting market trends was almost laughable. Sounds bizarre, right? But what if I told you that beneath that chaos lay a hidden order? A set of powerful ideas that would turn the world of finance upside down. Ideas so revolutionary that they transformed investing from a high-stakes gamble into a sophisticated science. This is the story of how that happened and why it changed everything. Enter Peter L. Bernstein's masterpiece, Capital Ideas, The Improbable Origins of Modern Wall Street. Bernstein takes us on an exhilarating journey through time, introducing us to the renegade thinkers, economists, mathematicians, and even physicists who dared to challenge centuries-old beliefs about risk, randomness, and reward. We'll uncover how Harry Markowitz's obsession with chess and logic led to the birth of modern portfolio theory, how Eugene Fama's curiosity about the efficiency of markets sparked a revolution, and how Fisher Black and Markowitz turned complex options pricing into a formula that shook the very foundations of Wall Street. These weren't just academics locked away in ivory towers, they were rebels, armed with equations and armed with a vision that finance could be mastered, understood, even predicted. They stared into the chaos of markets and saw patterns, they saw opportunities. And they weren't afraid to tell the old guard they were dead wrong. So, grab your coffee, hit that subscribe button, and prepare to have your mind blown as we unravel the secrets behind modern finance. The theories, the legends, and the audacious ideas that took Wall Street from chaos to science. This is more than a history lesson. It's a story of ambition, controversy, and the relentless pursuit of truth. Let's get into it. Our story begins in the mid-20th century, a time when finance was more art than science. Picture it. Wall Street was a swirling storm of intuition and gut feelings, where traders relied more on whispers and stock tips than on any kind of systematic analysis. There was no blueprint, no science, just a chaotic scramble for profits. But then came a group of revolutionary thinkers, outsiders, really. They weren't the typical cigar-smoking financiers of the time. These were academics, mathematicians, and economists. Names like Harry Markowitz, William Sharpe, Eugene Fama, and a handful more who would forever change the game. They were the unlikeliest of heroes, and their mission? To decode the randomness of markets and prove that risk could not only be measured but managed. They believed that beneath the chaos of stock prices lay patterns, that every gamble on Wall Street could be understood with the right tools. And at the core of this revolution was a single, powerful concept: risk versus return. It was a radical idea that by understanding risk, you could make smarter bets and even predict how markets behave. This wasn't just a theory, it was a manifesto that would challenge everything Wall Street believed. Before Harry Markowitz, investing was more about superstition than science. Your neighbor's hot stock tip, or a gut feeling after reading the morning paper, was as good a strategy as any. The risks were nebulous, the rewards unpredictable. But Markowitz, he wasn't satisfied with superstition. He was a chess player at heart, obsessed with logic, patterns, and probabilities. So, he asked a question that no one else had dared to. What if we could quantify risk? What if investing wasn't about luck or instinct, but about cold, hard math? This one question would become the foundation of a new era in finance. His solution was revolutionary: the modern portfolio theory. In a paper that would eventually win him the Nobel Prize, Markowitz introduced a mathematical framework for diversifying investments to balance risk and return. He argued that it wasn't just about picking the right stocks, but about how you combine them. The idea was simple yet profound. By investing in a mix of assets that don't move together, you could reduce overall risk without sacrificing returns. Think of it like this. Instead of betting everything on one horse at the racetrack, you spread your bets smartly across different horses to ensure a win, no matter which one crosses the finish line first. Markowitz showed that a carefully constructed portfolio could weather market storms and deliver consistent gains. And just like that, the era of scientific investing had begun. Wall Street was about to trade its crystal balls for calculators, its gut feelings for algorithms. But Markowitz was only the beginning. His ideas would spark a financial revolution, paving the way for the efficient market hypothesis, the capital asset pricing model, and the powerful quantitative strategies that dominate Wall Street today. It was the dawn of a new age, where finance wasn't just about making money, but understanding why and how markets move. The stakes were higher, the theories bolder, and the visionaries behind them. They were just getting started. So, how did these radical ideas spread from academic journals to the trading floors of Wall Street? And what happens when theories collide with the chaos of real-world markets? But the story doesn't stop there. If Harry Markowitz cracked the code on risk, then Eugene Fama took a sledgehammer to Wall Street's old guard with a theory so bold it sparked a firestorm of controversy, the efficient market hypothesis. Imagine telling a room full of Wall Street titans that their carefully guarded secrets, their market-beating strategies, and their years of experience were all, well, pointless. That's exactly what Fama did. Fama's argument was deceptively simple yet profound. Stock prices always reflect all available information. Every earnings report, every economic forecast, every whispered tip from a broker, it's all instantly baked into the price. In Fama's world, the market is a ruthless information processing machine that leaves no room for human intuition or secret strategies. If he was right, then all those expensive stock-picking services, the so-called experts on TV, even the most brilliant fund managers were little more than well-dressed gamblers. Because if prices always reflect all information, then beating the market consistently wasn't just hard, it was impossible. You might get lucky once or twice, but in the long run, you'd lose out to the relentless efficiency of the market. It was a declaration of war against the very foundations of Wall Street. Financial gurus were outraged. Imagine years of experience and millions of dollars invested in research and analysis suddenly called into question by a professor with a stack of data and a radical idea. Hedge fund managers scoffed. Traders rolled their eyes, but Fama was undeterred. Armed with decades of data, he set out to prove that market prices were not just efficient but nearly impossible to outsmart consistently. And he did. Study after study seemed to confirm Fama's hypothesis. Mutual funds fail to beat the market more often than not. Even professional traders found their strategies falling short. The efficient market hypothesis became the cornerstone of what's now known as the passive investing revolution. The idea that instead of trying to beat the market, the smarter play was to just ride with it. Enter the rise of index funds, those low-cost, no-nonsense investments that simply mirror the market's performance. And here's the kicker. Warren Buffett, the Oracle of Omaha himself, once bet $1 million that a simple S&P 500 index fund would outperform a collection of hedge funds over a decade. Spoiler alert, the index fund won by a landslide. Fama's theory wasn't just reshaping academic circles, it was turning the investment world on its head. But Fama's ideas didn't just spark debates in lecture halls, they ignited a revolution in investing. Suddenly, everyone from pension funds to average Joes with retirement accounts started ditching high-cost fund managers for low-cost index funds. Billions of dollars shifted almost overnight, and Wall Street would never be the same. So, was Fama right? Is the market truly unbeatable? Or were there cracks in the theory just waiting to be exposed? As we dig deeper, we'll see how other visionaries picked up where Fama left off, challenging his ideas, refining them, and pushing the science of finance even further. But wait, it gets even crazier. Just when you thought the revolution couldn't go any further, the story shifts to perhaps the most mind-bending chapter of all, the invention of option pricing models. Imagine being able to put a precise price on uncertainty itself, to take the chaos of markets and translate it into a neat, calculable figure. This wasn't just a breakthrough, it was financial wizardry of the highest order. At the center of it all were Fisher Black, Black-Scholes, and Robert Merton, three academics who looked more like mild-mannered professors than financial sorcerers. Yet, with chalk-dusted fingers and pages of equations, they conjured a formula that would change the face of finance forever: the Black-Scholes model. Their quest began with a deceptively simple question: how do you value an option? The right to buy or sell a stock in the future, when the future is so unpredictable. Options were seen as financial voodoo at the time, too complex and too risky for most traders. But Black-Scholes and Merton were obsessed. They weren't interested in trading tips or Wall Street gossip. They wanted the math, the truth hidden beneath the numbers. So, they locked themselves away with stacks of data, drawing inspiration from unexpected sources, like the physics of heat diffusion. Yes, you heard that right. The very same equations used to model how heat spreads through a metal rod became the blueprint for pricing financial options. The result? A formula so powerful it was like giving Wall Street a crystal ball, a way to see the potential future price of a stock stripped of uncertainty. This wasn't just about making money, it was about mastering risk, about turning uncertainty into opportunity. For the first time, traders could calculate the fair price of options with surgical precision, hedging their bets with a confidence that was previously unimaginable. The impact was immediate and explosive. By 1973, the Chicago Board Options Exchange had launched, and within years, options trading went from a niche gamble to a cornerstone of modern finance. And here's the wildest part. Scholes and Merton would go on to win the Nobel Prize in Economics for their work in 1997. Fisher Black, who had tragically passed away, was ineligible for the prize, but his legacy was cemented as one of the greatest innovators in financial history. Their model wasn't just a breakthrough, it was the spark that ignited the rise of derivatives, a trillion-dollar market that would dominate finance for decades to come. But like all powerful tools, the Black-Scholes model was a double-edged sword. As the model spread, some traders wielded it without fully understanding its limitations, setting the stage for both unprecedented profits and catastrophic losses, stories we'll uncover later. The irony? The very tool designed to tame risk would end up amplifying it in ways even its creators couldn't predict. The Black-Scholes model wasn't just a formula, it was a statement, a bold claim that even the wildest uncertainties of the market could be understood, priced, and controlled. It symbolized the ultimate triumph of math over madness, of science over speculation. But as we see, even the most powerful ideas have their limits. So, was this really the ultimate invention in finance, or just the beginning of something even bigger? Stick around as we dig deeper into the genius, the greed, and the risks that came next. Peter L. Bernstein's book, Capital Ideas, isn't just about equations and theories. It's about the human spirit of curiosity, the relentless quest to find meaning in the chaos of financial markets. It's a story of visionaries who saw what others couldn't, that markets, like the universe itself, have an underlying order. They were the Galileo and Newton of finance, peering through the fog of speculation and superstition to reveal a world governed by logic, data, and probability. From Nobel laureates to unlikely academics working in obscurity, these pioneers weren't motivated by money or fame. They were chasing something bigger, the truth. For Harry Markowitz, it was the puzzle of balancing risk and reward. For Eugene Fama, it was the challenge of proving that markets were more efficient than anyone believed. For Fisher Black and Black-Scholes, it was the thrill of untangling the mystery of options pricing. Each of them contributed a vital piece to the puzzle, transforming Wall Street from a den of gamblers into a realm of probabilities, portfolios, and predictive power. But it wasn't just about the math. It was about the courage to defy the old guard, the powerful bankers and traders who scoffed at the idea that academics had anything to teach them. It was about risking ridicule, rejection, even financial ruin to advance a new vision of finance. When Fama declared that stock prices moved with the efficiency of a well-oiled machine, Wall Street laughed. When Markowitz suggested diversifying across assets to manage risk, traditionalists called it naive. Yet, over time, The data spoke louder than the critics. Bernstein captures this struggle with an intensity that reads more like an adventure novel than a finance book. He brings to life the heated debates, the midnight brainstorming sessions, and the thrill of discovery, the moments when a chalkboard full of equations suddenly revealed a new truth about the markets. You can almost see Fama defending the efficient market hypothesis in a crowded lecture hall, or Black scribbling formulas late into the night, chasing a solution that seemed just out of reach. These weren't ivory tower academics. They were rebels armed with calculators and an unshakable belief that markets could be understood, predicted, even tamed. They weren't just changing finance, they were changing how we think about risk, uncertainty, and opportunity itself. The story of Capital Ideas isn't just the story of Wall Street. It's the story of how we make sense of an uncertain world. If you found this journey as mind-blowing as I did, smash that like button, share your thoughts in the comments, and don't forget to subscribe for more deep dives into the world of finance and beyond. Who knows? Maybe the next big financial revolution will start with a question from you. Thanks for watching, and remember, keep questioning, keep learning, and keep investing in your knowledge.